Indian Economy by Ramesh. Chapter 17. Tax Structure in India. Through taxes, government in reality decides how to draw the required resources from the nation's households and businesses for public purposes. The money raised, so is the vehicle by which real resources are transferred from private goods to public goods. Tax. Modern economics defines tax as a mode of income redistribution. There might be other ways also to look at it. The usual meaning of tax people think is that a tax is imposed by the government to fulfill its important obligations on the expenditure front. We may take an example to see how taxes redistribute income. Suppose an economy has a flat rate of income tax 30%. Just see the impact of this tax on the income disparity of two people and be earning 50,000 rupees and 80,000 rupees, respectively. We see here through the above given table as how the income disparity between two individuals and B decreases from 30,000 rupees to 21,000 rupees after paying taxes. This is the first level when incomes of these individuals have got redistributed. Now the money the government has got by tax collection, i.e., 39,000 rupees, 15,000 rupees plus 24,000 rupees, will be spent on different sectors, infrastructure, education, health, etc., which will provide services to each and everybody alike. Here income is redistributed at the secondary level. Consider a person who pays income tax, but does not take services of government schools for his children's education, nor goes to the government hospitals for medical services, and compare him with a person who has no option other than the government schools and the hospitals, the higher taxpayer getting no government services and a lower taxpayer getting all the services. Here income looks redistributed from the consumption side. Incidence of tax. The point where tax looks as being imposed is known as the incidence of tax, the event of tax imposition. Impact of tax. The point where tax makes its effect felt is known as the impact of tax, the after effect of tax imposition. Direct tax. The tax which has incidence and impact both at the same point is the direct tax. The person who is hit, the same person bleeds. As for example income tax, interest tax, etc. Indirect tax. The tax which has incidence and impact at the different points is the indirect tax. The person who is hit does not bleed someone else's blood. As, for example, excise, sales tax, etc. are imposed on either the producers or the traders, but it is the general consumers who bear the burden of tax. Methods of taxation. There are three methods of taxation prevalent in economies with their individual merits and demerits. Progressive taxation. This method has increasing rates of tax for increasing value or volume on which the tax is being imposed. Indian income tax is a typical example of it. The idea here is less tax on the people who earn less and higher tax on the people who earn more, classifying income earners into different slabs. This method is believed to discourage more earnings by the individual to support low growth and development unintentionally. Being poor is rewarded while richness is punished. Taxpayers also start evading tax by showing lower unreal income. But from different angles this tax is proper and taxes people according to their affordability or sustainability. This is the most popular taxation method in the world and a populist one too. Regressive taxation. This is just opposite to the progressive method, having decreasing rates of tax for increasing value or volume on which the tax is being imposed. There are not any permanent or specific sectors for such taxes. As a provision of promotion, some sectors might be imposed with regressive taxes. As for example, to promote the growth and development of small-scale industries, India at one time had regressive excise duty on their productions. With increasing slabs of volume they produced, the burden of tax used to go on decreasing. This method, while appreciated for rewarding the higher producers or income earners, is criticized for being more taxing on the poor and low producers. This is not a popular mode of taxation and not as per the spirit of modern democracies. Proportional taxation. In such a taxation method, there is neither progression nor regression from the point of view rate of taxes point of view. Such taxes have fixed rates for every level of income or production. They are neutral from the poor or rich point view or from the point of view of the levels of production. Usually, this is not used by the economies as an independent method of taxation. Generally, this mode is used as a complementary method with either progressive or regressive taxation. If not converted into proportional taxes, every progressive tax will go on increasing and similarly every regressive tax will decrease to zero, becoming completely a futile tax methods. That is why every tax, be it progressive or regressive in nature, must be converted into proportional taxes after a certain level. A good tax system. What are the characteristics of a good tax system? There has always been a debate among economists and policymakers on the issue of design of the tax system. Taxation in developing economies has been even more debated as the trade-off assessment generates enough controversy. Main debatable issues in the design of a tax system are whether progressive or regressive taxation, direct tax or indirect tax collections should be higher, whether revenue deficit is better, etc. The controversies set apart, there is a broad consensus on 5 principles of a good tax system among economists and the policymakers. Fairness. Though fairness, i.e., the first criteria of a good tax system, is not always easy to define, economists suggest inclusion of 2 elements in the tax system to make it fair, namely, horizontal equity and vertical equity. Individuals in identical or similar situations paying identical or similar taxes is known as horizontal equity. When better off people pay more taxes, it is known as vertical equity. Efficiency. Efficiency of a tax system is its potential to affect or interfere the efficiency of the economy. A good tax system raises revenue with the least cost on the taxpayers and least interference on the allocation of resources in the economy. The tax system affects the economic decisions of individuals and groups by either encouraging or discouraging them to save, spend, invest, etc. Taxes can improve efficiency of the economy. Taxes on pollution or on smoking give revenue to the government and serves broader social purposes too. This is known as the double dividend of a tax. Administrative simplicity. This is the third criterion, which includes factors like computation, filing, collection, etc. of the taxes, that all should be as simple as possible. Simplicity checks tax evasion too. Tax reform in India has simplification of tax as its major plank, also recommended by the Chelia Committee. Flexibility. A good tax system has the scope of desirable modifications in it if there is any such need. Transparency. How much tax taxpayers are actually paying, and what are they getting against it in the form of the public services should be ascertainable, i.e., the transparency factor. Methods of expenditure. Similar to the methods of taxation, the modes of government expenditure are also of three types: progressive, regressive, and proportional. At first instance, it seems that as a country achieves better levels of development, sectoral and the item-wise expenditure of the economy must have decreasing trends. But practical experience shows that the level of expenditure needs enhancement every day, and economy always needs more and more revenues to fulfill the rising expenditures. That is why for economies the best form of government expenditure is the progressive expenditure. The best way of taxation is progressive, and the best way of government expenditure is also progressive, and they suit each other beautifully. Most of the economies around the world are having progressive taxation with progressive expenditure. Value-added tax. The value-added tax, VAT, is a method of tax collection as well as name of a state-level tax at present in India. A tax collected at every stage of value addition, i.e., either by production or distribution, is known as value-added tax. The name itself suggests that this tax is collected on the value addition, i.e., production. Production of goods or services is nothing but stages of value additions where production of goods is done by the industrialists or manufacturers. But these goods require value addition by different service providers or producers, the agents, the wholesalers, and the retailers, before they reach the consumers. From production to the level of sale, there are many points where value is added in all goods. VAT method of tax collection is different from the non-VAT method in the sense that it is imposed and collected at different points of value addition chain, i.e., multi-point tax collection. That is why there is no chance of imposing tax upon tax, which takes place in the non-VAT method, single-point tax. (2019 to 2020). Though the government was focused on removing the technical glitches related to the GST network even by mid-2020, the GSTN portal had already emerged a major source of data available in the public domain. This data repository, once mined as per the developmental needs, will necessarily give the country a better and diversified understanding of the economy. Commodities Transaction Tax. The Union Budget 2013-14 has basically reintroduced, the Commodities Transaction Tax, CTT, however, only for non-agricultural commodity futures at the rate of 0.01%, which is equivalent to the rate of equity futures on which a Securities Transaction Tax is imposed in India. Along with this, transactions in commodity derivatives have been declared to be made non-speculative, and hence for traders in the commodity derivative segment, any losses arising from such transactions can be set off against income from any other source. Similar provisions are also applicable for the securities market transactions. Like all financial transaction taxes, CTT aims at discouraging excessive speculation, which is detrimental to the market, and to bring parity between securities market and commodities market such that there is no tax or regulatory arbitrage. Futures contracts are financial instruments and provide for price risk management and price discovery of the underlying asset, commodity or currency or stocks or interest. It is, therefore, essential that the policy framework governing them is uniform across all the contracts irrespective of the underlying assets to minimize the chances of regulatory arbitrage. The proposal of CTT also appears to have stemmed from the general policy of the government to widen the tax base. Commodities Transaction Tax, CTT, is a tax similar to Securities Transaction Tax, STT, proposed to be levied in India on transactions done on the domestic commodity derivatives exchanges. Globally, commodity derivatives are also considered as financial contracts. Hence, CTT can also be considered as a type of financial transaction tax. The concept of CTT was first introduced in the Union Budget 2008-09. The government had then proposed to impose a Commodities Transaction Tax, CTT, of 0.017%, equivalent to the rate of equity futures at that point of time. However, it was withdrawn subsequently as the market was nascent then, and any imposition of transaction tax might have adversely affected the growth of organized commodities derivatives markets in India. This has helped Indian commodity exchanges to grow to global standards. MCX is the world's number 3 commodity exchange. Globally, MCX is number 1 in gold and silver, number 2 in natural gas, and number 3 in crude oil. Securities Transaction Tax. The Securities Transaction Tax, STT, is a type of financial transaction tax levied in India on transactions done on the domestic stock exchanges. The rates of STT are prescribed by the central government through its budget from time to time. In tax parlance, this is categorized as a direct tax. The tax came into effect from 1st October 2004. In India, STT is collected for the Government of India by the stock exchanges. With charging of STT, long-term capital gains tax was made 0 and short-term capital gains tax was reduced to 10%, subsequently changed to 15% since 2008. The STT framework was subsequently reviewed by the central government in the year 2005, 2006, 2008, 2012 and 2013. The STT rates were revised upwards in the year 2005 and 2006 while it was reduced for certain segments in 2012 and 2013. The STT provisions were altered in the year 2008 such that for professional traders, brokers, STT came to be treated as an expense which can be deducted from the income instead of treating the same as an advance tax paid. The 2004 STT provisions provided that the STT payments of professional traders, whose business income arising from purchase and sale of securities could be set off against their total tax liability. As on date, STT is not applicable in case of preference shares, government securities, bonds, debentures, currency derivatives, units of mutual fund other than equity-oriented mutual fund, and gold exchange-traded funds, and in such cases, tax treatment of short-term and long-term gains shall be as per normal provisions of law. Transactions of the shares of listed companies on the floor of the stock exchange or otherwise mandated under the regulatory framework of SEBI, such as takeover, buyback, delisting offers, etc., also does not come under STT framework. The off-market transactions of securities, which entails changes in ownership records at depositories, also does not attract STT. Capital Gains Tax. This is a direct tax and applies on the sales of all assets if a profit, gain, has been made by the owner of the asset, a tax on the gains one gets by selling assets. The tax has been classified into two: 1. Short-term capital gain, STCG, it applies if the asset has been sold within 36 months of owning it. In this case, the rate of this tax is similar to the normal income tax slab. But the period becomes 12 months in cases of shares, mutual funds, units of the UTI, and zero coupon bond. In this case, the rate of this tax is 15%. 2. Long-term capital gain, LTCG. It applies if the asset has been sold after 36 months of owning it. In this case, the rate of this tax is 20%. In cases of shares, mutual funds, units of the UTI, and zero coupon bond, there was exemption, zero tax, though recently, a LTCG of 10% above 1 lakh rupees of capital gains was introduced on them by the government. Minimum alternate tax. The minimum alternate tax, MAT, is a direct tax imposed on the zero tax companies at the rate of 18.5% on their book profit. This was first imposed in 1997 to 98. Basically, income tax is paid as per the provisions of the Income Tax Act, IT Act, but companies calculate their profit through profit and loss account as per the provisions of the Companies Act. The IT Act allows several kinds of exemptions and other incentives from total income together with deductions on the gross income. Again, the rates of depreciation under the Companies Act is higher than the IT Act. As a result of these exemptions, deductions, and other incentives under IT Act together with higher depreciation under the Companies Act, companies show their taxable income either nil or negative, and this way, the zero tax companies emerge. Practically, zero tax companies might be having high book profit and distributing huge dividends under the Companies Act to their shareholders too, but showing nil or negative taxable income under the IT Act. They might not pay any income tax. To bring such companies under the income tax, Section 115 JB was introduced in the IT Act in 1997 to 98, and MAT was imposed accordingly. MAT is a way of making companies pay minimum amount of tax. It is applicable on all companies except those engaged in infrastructure and power sectors, free trade zones, charitable activities, venture and angel funds. Foreign companies with income sources in India also come under it. In 2015, the government rationalized the MAT provisions for the FIIs, foreign financial institutions. Now they do not need to pay MAT on their profits from capital gains on transactions in securities, which are liable lower tax rate. We may take an example. Suppose a company has book profit of 10 lakh rupees. And, after claiming the deductions, exemptions, and depreciation, its gross taxable income comes down to 6 lakh rupees, its taxable income becoming 4 lakh rupees. In this case, the applicable income tax would be 1.2 lakh rupees if rate of income tax is 30% flat. But the company will pay a MAT of 1.85 lakh rupees at the rate of 18.5% on its book profit of 10 lakh rupees. The concerned company needs to pay the tax, which is higher. Here, the tax to be paid will be 1.85 lakh rupees. At present, the tax is collected as an advance tax. The tax can be carried forward and set off, adjusted, against regular tax payable during the subsequent 10-year period, known as MAT credit. There has been a strong demand to abolish this tax in the country. In April 2017, the government started phasing out the exemptions available to the companies on it from April 2017. So that companies are able to use MAT credit. The carry-forward period has been also increased to 15 years. Corporate tax reform. The joint stock companies, more popular as companies and corporate sector in India, pay a direct tax known as corporate income tax, popular as corporate tax, on their annual profits. The existing rates used to be 30% for the domestic and 35% for the foreign companies operating in the country. Following the ongoing process of corporate tax reforms, the government, in September 2019, effected a major change in the corporate income tax, CIT. The change, which was enforced from fiscal 2019 to 20, is being briefly summarized below. For the existing companies, with gross turnover over 400 crores rupees, the base corporate tax was cut from 30 to 22%. Thus, the effective rate, i.e. inclusive of surcharge and cess, fell down from 34.61 to 25.17%. Companies can opt for the new tax rate by foregoing the deductions and exemptions availed by them. This will benefit 0.9% of the companies, i.e. large ones, operating in the country, their number being 4,698. For the new manufacturing companies, with gross turnover below 400 crores rupees, registered on or after 1st October 2019, the rate was cut from 25 to 15%. In this case, the effective rate of tax fell down to 17.16%. This will benefit 99.1% companies, i.e. small and medium ones, of the country. This drastic move was aimed at three major objectives. Firstly, boosting the production volume of the manufacturing sector, which involves a large number of MSMEs, including the newly launched startups. Secondly, attracting higher investments in manufacturing industries. And thirdly, creating more job opportunities. The rate structure was left unchanged for the foreign companies. Logic behind the reform: in recent times, the corporate tax was cut by many countries across the world to attract investment and create jobs. India's move was an immediate response to rate cuts initiated by Asian developing countries, which compete with India in the global export markets. After the reform move, the corporate tax rate in India, for new manufacturing companies in particular, is lower than most of the ASEAN countries. Tax rate, percent. Timer. 10. Singapore. 17. Brunei. 18.5. Vietnam. 20. Thailand. 20. Cambodia. 20. Malaysia. 24. Laos. 24. Myanmar. 25. Indonesia. 25. Philippines. 30. Source: Department of Revenue, Ministry of Finance, GOI, N. Delhi, April 2020. Other than attracting investment and enhanced job creation, the move is also expected to have a multiplier effect on the economy, increased income levels, and higher tax collections in the medium to long term. Dividend Distribution Tax. The ownership of joint stock companies, i.e. the limited firms, rests in the hands of their shareholders. Thus, such companies pay dividend, i.e. a part of profit, to their shareholders once they book operating profits. The dividend paid, distributed, by the companies to the shareholders used to attract a direct tax in India known as the Dividend Distribution Tax, DDT. It means, before dividend to get paid to the shareholders, the DDT was to be paid to the tax department, that is known as payment of DDT in the hands of the companies. The rate of tax till March 2020 used to be 15%. Starting with the financial year 2020 to 2021, the government effected a major change in regard to the DDT. Now companies don't need to pay this tax anymore. Now, the joint stock companies will transfer the dividend directly to the shareholders without deducting the tax. This way, the dividend earned by shareholders will be part of their personal income, which will attract personal income tax in place of dividend tax. It means dividends will still attract the direct tax, i.e. individual income tax, in the hands of the recipients in place of the companies, which used to pay the DDT. But still it will make a revenue loss to the government, as the tax will not apply now with a flat rate of 15%, rather get paid as per the income slabs of the recipients. The change is estimated to entail a revenue loss of 25,000 crores rupees annually. Experts and stakeholders used to argue that the DDT resulted in increasing the tax burden for investors who already pay an income tax, i.e. corporate income tax, on their annual profits. This used to pinch those investors who are liable to pay tax less than the rate of DDT if the dividend income is included in their personal income, as personal income tax has various slabs. Further, non-availability of credit of DDT to most of the foreign investors in their home country resulted in reduction of rate of return, ROR, on equity capital for them. The move is aimed at making Indian equity market more attractive for investors, domestic as well as foreign. This move is supposed to provide a channel to Indian population to be part of the formal process of wealth creation in the country besides routing investment in the nation building. Tax expenditure. There has been a divergence between the official tax rate and effective tax rate in India, defined as the ratio of total tax collected to the aggregate tax base. The divergence occurs mainly on account of tax exemptions. Tax expenditure is also known as revenue foregone. But such foregone taxes does not necessarily mean that they have been waived off by the government. Better, it should be interpreted as incentives given by the government to promote certain sectors, in absence of which they may not have come up. High tax expenditure can make the tax system unduly complex and bring in distortions in it. As a result of simplification in the tax system and improvements in tax administration in recent years have brought tax expenditure down, current situation is as given below. 1. 15% for corporate tax, 32% of 2007-08. 2. 16% for income tax, 37% in 2007-08. 3. 100% for excise duty, 70% in 2007-08. It was at a high level of 162% in 2009-10 on account of tax concessions announced by the GOI to control inflation. 4. 160% for custom duty, 92% in 2007-08. It was at a high level of 235% in 2009-10 due to concessions announced for custom duty in wake of controlling prices. To realize full tax potential, the government needs to limit exemptions and their grandfathering together with broadening the tax base. The level of tax expenditure is slated to fall steeply once the proposed GST is operationalized in the country. Under its process of rationalizing the corporate tax, cutting it down from 30 to 25%, the government is also aimed at calibrating, phasing out, the various tax exemptions or incentives which exists for the various industries. Collection rate. Collection rate is the ratio of total customs revenue and the total value of imports for a year. This is an indicator of overall incidence of customs including countervailing duties, CVD, and special additional duties, SAD, on imports. Several exemptions are offered by the GOI in customs duty on a variety of imports. This is the reason why India's customs collection does not increase as much its imports increase. India's collection rate had declined during 2009 to 14, falling down to 5.5%, particularly due to multiple custom exemptions announced by the government on several items of import in wake of rising inflation rate during the period. Since then it started improving and by now it stands at 6.6%. Legitimacy and Taxation. India commenced with a broad-based tax reforms program in 1991 as an important part of the economic reforms process. Simplifying tax structure, cutting rate of taxes, enhancing tax compliance, and broadening the tax base are the major contours of this reform program. But even today, India has not fully translated its democratic vigor into commensurately strong fiscal capacity. The tax base of India is still not adequate. To build fiscal capacity, it is essential to create legitimacy in the state. In this regard, the Economic Survey 2015-16 presented a very timely and suitable piece of analysis. The document adds that to build fiscal capacity, the government needs to put in place a better tax regime, which is only possible once the government is able to enhance its legitimacy among the citizens. The suggestions forwarded by the survey in this regard are briefly being given here. 1. The spending priorities of the government must include essential services which are consumed by all citizens. For that matter, action needs on public infrastructure, law and order, less pollution and congestion, etc. 2. Reducing corruption must be a high priority. Though this will be fiendishly, clever and imaginative, difficult. This is needed not just because of its economic costs, but also because it undermines legitimacy of the state. The more citizens believe that public resources are not wasted, the greater they will be willing to pay taxes. Improving transparency through efficient auctioning of public assets will help create legitimacy and over time strengthen fiscal capacity. 3. Subsidies to the well-off need to be scaled back. At present, it is estimated to be around 1 lakh rupees crore. Phasing down these bounties and targeting subsidies for the poor is important in strengthening legitimacy. In the same way, the existing regime of tax exemptions redistributes income towards the richer private sector. It dilutes the legitimacy of the state in the eyes of the poor citizens. There is need of putting in place a reasonable taxation provision for the better off section in the country regardless of where they get their income from, industry, services, real estate, or agriculture. 4. Property taxation needs to be developed. India lacks systematic data on property tax, and whatever is there, it is very sparse. This proves the low attention the country has given to this issue. As property taxes are progressive, they are desirable. It makes more sense because evading this tax is difficult as they are imposed on immovable, non-mobile assets. With the help of today's technologies, such properties can be easily identified. Higher rates on properties, with values updated periodically, can be the foundation of local government's finances. This can provide local public goods and strengthen democratic accountability and more effective decentralization. Higher property tax rates would also put sand in the wheels of property speculation. Smart cities require smart public finance, and for India's urban future, a sound property taxation regime will be vital. One low-hanging fruit is to avoid raising exemption threshold and allow natural growth in income to increase the number of the taxpayers. The survey has suggested a simple method for it, in action. In 2016 to 17 itself, the government began this process. Exemption limit for individual income tax has been left unchanged together with a program to link corporate tax cut and phase out of the exemption regime existing for the companies. Income and consumption anomaly. India's tax to GDP ratio is very low, and the proportion of direct tax to indirect tax is not optimal from the viewpoint of social justice. The data released by the government indicate that India's direct tax collection is not commensurate with the income and consumption pattern of the people. Corporate tax, as against 5.6 crore informal sector, unorganized sector, individual enterprises and firms doing small business, of which 1.81 crore filed tax returns. Out of the 13.94 lakh companies registered in India, 5.97 lakh filed tax returns for 2016 to 17 assessment year, which show the following annual profit before tax pattern. 2.76 lakh companies have shown losses or zero income. 2.85 lakh companies had less than 1 crore rupees profit. Profit of 28,667 companies was between 1 crore rupees to 10 crore rupees, and only 7781 companies have profit of more than 10 crores rupees. Individual income tax, as against estimated 4.2 crore persons engaged in organized sector employment, the number of individuals filing return for salary income are only 1.74 crore. In 2015 to 16, assessment year 2016 to 17, a total of 3.7 crore individuals filed income tax returns, which did show the following annual income pattern. 99 lakh show annual income below the exemption limit of 2.5 lakh rupees, 1.95 crore show income between 2.5 rupees to 5 lakh rupees, 52 lakh show income between 5 rupees to 10 lakhs rupees. Only 24 lakh people show income above 10 lakhs rupees, 76 lakh people declared income above 5 lakh rupees, 56 lakh being salaried class, and only 1.72 lakh people did show income more than 50 lakh rupees. The demonetization process has given the government new data related to people's income. About 1.09 crore accounts saw average deposit between 2 rupees to 80 lakh. Deposits of more than 80 lakh were made in 1.48 lakh accounts, with average deposit size of 3.31 crores rupees. This data mining will help the government in increasing the tax net and tax revenue in future. The above given data can be contrasted with the fact that in the last 5 years, more than 1.25 crore cars have been sold, and number of Indian citizens who flew abroad, either for business or tourism, was 2 crore in the year 2015. From all these figures, it can be concluded that India is largely a tax non-compliant society. The predominance of cash in the economy makes it possible for the people to evade their taxes. When too many people evade taxes, the burden of their share falls on those who are honest and compliant. Impact of demonetization. As per the Economic Survey 2017-18, one of the aims of demonetization and the GST, Goods and Services Tax, was to increase the formalization of the economy and bring more people into the income tax net, which includes only about 59.3 million individual taxpayers filers and those whose tax is deducted at source in 2015 to 16, equivalent to 24.7% of the estimated non-agricultural workforce. It looks happening. In 13 months from demonetization, November 2016 to November 2017, 10.1 million new income tax filers were added. In the preceding 6 years, only 6.2 million new income tax filers were added. Though, the new tax filers, in many cases reported income close to tax threshold, standard deduction of 2.5 lakhs rupees per annum. As the income growth of such tax filers crosses the threshold, tax revenue of the government will also grow. Ease of paying taxes. India has given high attention on improving its rank in the Doing Business report of the World Bank. It jumped up 79 positions out of 190 countries in the latest report, improving from 142nd of 2014 to 63rd in 2019, Doing Business 2019. However, its rank still continues to trail on 4 parameters, one being paying taxes, rest of the 3 being starting business, registering property, and enforcing contracts. A comparative picture of ease of paying taxes in India and few other countries, especially the peers like China, Brazil, and Indonesia, are being summarized below. India's rank in ease of paying taxes has, however, improved from 156 in 2014 to 115 in 2019, but it has been much below expectations. India performs lowly in case of number of tax payments, while in India the number is 12, from 59 of 2009, it is only 7 in China, 10 in Brazil, and 26 in Indonesia. Rs. taken per year in paying taxes are also comparatively higher in India, 250 to 254 Rs in India, while only 138 in China, 1501 in Brazil, quite higher, and 191 in Indonesia. In New Zealand it takes only 140 Rs per year in paying taxes. On this front, however, the situation has deteriorated in the country. Time spent in paying taxes got just doubled in the last decade, 2009 to 19. India trails in case of total tax payable, percent of gross profits, in comparison to most of the peers also, while it is 49.7 for India. It is 59.2 for China, 65.1 for Brazil, and 30.1 for Indonesia. In case of paying taxes, although Indonesia, 26, has more than double the number of payments per year than India, 10 to 12, its citizens spend far less time in paying them than India. Brazil seems to fare particularly poor in this segment. These parameters provide a measure of the scope for improvement. To emerge an economy of $5 trillion, India needs to channelize all of its resources and focus on improving the ease of paying taxes. Businesses, industries together with individual and companies all feel good if it takes less time in paying taxes. Simplification of direct tax system. Moving towards direct tax reforms, the government has effected many fundamental changes in the tax administration. Major reforms and their impact are as briefed below. Significant increase in tax collections from 6.38 lakh rupees crores in 2013 to 14 to almost 12 lakh rupees crores in 2018 to 19. Tax base growth rate of 80%. With 6.85 crore tax returns filed in 2018 to 19, in comparison to 3.79 crore of 2013 to 14. Tax Department now functions online. The interface of taxpayers with the tax department has become much simpler and largely faceless. Returns, assessments, refunds and queries all are now undertaken online. Around 99.54% of the income tax returns were accepted as they were filed in 2017 to 18. By late 2018, government approved a path-breaking, technology-intensive project to transform the tax department into a more assessee-friendly one under which all returns will be processed in 24 hours and refunds issued simultaneously. As per the proposal, by 2020 to 21, almost all verification and assessment of returns selected for scrutiny to be done electronically without any personal interface between taxpayers and tax officers. Reforms of 2019 to 20. As was promised under the tax reforms, with improving tax compliance, the tax rates will also fall. The government announced several such measures in the direction. Individual taxpayers having taxable annual income up to 5 lakhs rupees to get full tax rebate and therefore not be required to pay any income tax. As a result, even persons having gross income up to 6.50 lakhs rupees may not be required to pay any income tax if they make investments up to 1.5 lakh rupees in provident funds, specified savings, insurance, etc. Included with additional deductions, such as interest on home loan up to 2 lakhs rupees, interest on education loans, National Pension Scheme contributions, medical insurance, medical expenditure on senior citizens, etc. Persons having even higher income will not have to pay any tax. This will provide tax benefit of 18,500 crores rupees to an estimated 3 crores middle-class taxpayers. For salaried persons, standard deduction raised from the current 40,000 rupees to 50,000 rupees to provide additional tax benefit of 4,700 crores rupees to more than 3 crores salary earners and pensioners. Notional rent on a second self-occupied house exempt from income tax. The tax was imposed if someone owns more than one house. TDS threshold for deduction of tax on rent is proposed to be increased from 1,80,000 rupees to 2,40,000 rupees for providing relief to small taxpayers. The benefit of rollover of capital gains increased from investment in one residential house to 2 residential houses for a taxpayer having capital gains up to 2 crores rupees to be availed once in a lifetime. TDS threshold on interest earned on bank or post office deposits raised from 10,000 rupees to 40,000 rupees. Reforms of 2020 to 2021, major direct tax reforms enacted by the government in the financial year 2020 to 21 are briefly summarized below. Aim to stimulating growth, simplify tax structure, bring ease of compliance, and reduce litigations. The personal income tax slabs have been restructured into 7 by the government. 1. Slab Rs 0-2.5 lakh. Exempt, no change. 2. Slab Rs 2nd May 2005 lakh. 5%, no change. 3. A slab Rs 5th July 2005 lakh. 10%, down from 20%. 4. Slab Rs 7th May 2010 lakh. 15%, down from 20%. 5. Slab Rs 10 to 12 lakh. 20%, down from 30%. 6. Slab Rs 12th May 2015 lakh. 25%, down from 30%. 7. Above 15 lakh rupees. 30%, no change. Around 70 of the existing exemptions and deductions, over 100, have been removed in the new tax regime. Taxpayers have been given the option to pay tax as per the old regime and keep enjoying the benefits of exemptions and deductions. New regime will entail a revenue loss of 40,000 crore rupees per year. Measures to pre-fill the income tax return initiated so that an individual who opts for the new regime gets pre-filled income tax returns and would need no assistance from an expert to pay income tax. Taxpayers' Charter, with the objective of enhancing the efficiency of the delivery system of the Income Tax Department, a Taxpayers' Charter is to be adopted. For a tax system to function smoothly and achieve the objective of compliance, an element of trust is required between taxpayers and the tax administration. Dividend Distribution Tax. To attract more investment in the share market, the government removed the payment of Dividend Distribution Tax, DDT, at the company's hand. Currently, companies were paying the DDT on the dividend paid to their shareholders at the rate of 15%, plus surcharge and cess. Now, the dividend income will get taxed in the hands of the recipients, i.e. shareholders, as part of their personal income. This will lead to an estimated revenue loss of 25,000 crore rupees per year. Concessional Corporate Tax. The concessional corporate tax rate of 15% plus surcharge and cess, announced for the newly incorporated domestic electricity generating companies, as it applies on the new manufacturing companies with annual gross turnover below 400 crore rupees. Sovereign Wealth Fund. Government announced 100% exemption on interest, dividend and capital gains income made by sovereign wealth funds of foreign governments on their investments made in priority sectors, notified before March 2024 with a minimum lock-in period of 3 years. Startups. Tax on the sale of SO, Employee Stock Option Plan, by employees has been deferred for 5 years or till employees leave the company or when they sell their shares, whichever is earliest. This step is aimed at boosting the startup ecosystem in the country. During their formative years, startups generally use ESOPs to attract and retain highly talented employees, as ESOP is a significant component of compensation for these employees. Earlier, ESOPs were taxable as perquisites at the time of exercise, which led to cash flow problem for the employees who did not sell the shares immediately and continued to hold the same for the long term. Faceless appeals, taking further step towards use of electronic mode, e-mode, and minimizing human interface in tax administration, the government has started faceless appeals in case of income tax returns. Faceless assessment is already in practice. Aim to impart greater efficiency, transparency, and accountability to the assessment process. Few years back, a new faceless assessment scheme was introduced by the government. Currently, most of the functions of the Income Tax Department are performed in e-mode without any human interface, such as filing of return, processing of returns, issuance of refunds, and assessment. Vivad Se Vishwas scheme, on the line of Sabka Vishwas scheme launched to reduce litigation in indirect taxes in 2019 to 20, which settled a total of 1.89 lakh cases in less than 1 year. The government launched a new scheme Vivad Se Vishwas in 2020 to 21 to reduce the litigation in direct taxes. By late January 2020, there were 4.83 lakh direct tax cases pending in various appellate forums, Commissioner, High Court, and Supreme Court. Under the scheme, which will remain open till June 2020, a taxpayer would be required to pay only the amount of the disputed taxes and will get complete waiver of interest and penalty, provided payment is made by March 2020. Those who avail this scheme after March 2020 will have to pay some additional amount. The cases under appeal are also eligible under the scheme. Outlook for future. Though, the process of tax reforms has been slower, similar to the process of the economic reforms, especially in case of indirect taxes. Its positive outcomes have encouraged the country to go for further reforms. Together with enhancing legitimacy in state, there is a need to making taxpayers aware about the need of filing their tax returns. Certain suggestions to improve the taxation system in current time are being briefly summarized below. Structural reforms done recently in corporate tax are commendable, but slowly all of the deductions and exemptions enjoyed by the taxpayers should be withdrawn and reduction in the base rate should be attempted. The ease of filing GST should be enhanced on priority basis. The technical glitches related to the GST filing system should be corrected as soon as possible to lessen unnecessary harassment faced by the tax filers. Enhancing ease of paying taxes is an essential part of good tax system. In this regard, India should take lessons from the peers like China, Brazil, and Indonesia other than New Zealand. Enhancing tax compliance is the need of hour, especially in case of the personal income tax. There needs a policy framework to be initiated to induce behavioral change in the taxpayers. The clamor for cutting personal income tax rates will not be practically possible for the government due to possible fall in revenue, till the base of this tax is not broadened, for which encouraging non-tax-paying citizens to start paying tax will be required. This move will be further strengthened by withdrawing the existing deductions and exemptions enjoyed by the taxpayers. Presence of the trust between taxpayers and the tax department is essential for encouraging voluntary compliance from the tax filers. For this to be done, government should put in place an effective and transparent tax administration. Reducing human interface should be tried with increased pace. The presence of fear and distrust for the tax department in the minds of taxpayers dilutes tax filing, and they need to be corrected in medium to longer term. Litigations and involved delays cause enormous damage to the exchequer besides harassing the taxpayers and wasting precious time of the appellate and various courts. All possible alternatives should be utilized to resolve them in speedier manner.